Welcome to The Explainer. Today we're looking at a highly specific slice of real estate investing, buying small multifamily properties in Kansas City. Specifically, we're talking about 2 to 4 unit buildings. Whether you're a local owner or an out-of-state investor, the real goal here is balancing undeniable cash flow potential with some very real management realities.
Before we really dive in, just a quick note. This explainer is strictly educational. It is absolutely not legal or tax advice. And remember that the Kansas City Metro sits right on a state line. Regulations, taxes, and landlord-tenant laws are going to vary pretty significantly depending on whether your property sits on the Missouri side or the Kansas side. Always account for those differences when you're doing your underwriting.
Here's our quick roadmap for today. First, the small multifamily appeal. Second, key investment advantages. Third, risks and management realities. Fourth, location and strategy. And finally, executing your investment plan.
All right, Section 1, the small multifamily appeal. Why exactly 2 to 4 units?
Well, it comes down to a massive shift in efficiency. Think about a traditional single-family home. You collect one rent check, right? Scaling up means buying another house entirely, which means scattered maintenance across totally different neighborhoods and, of course, multiple roofs to worry about. But with a 2 to 4 unit property, you are collecting multiple rents under one single roof, all on one lot. Especially in an affordable market like Kansas City, this setup often cranks out much stronger cash flow per dollar invested.
Moving right along to Section 2, key investment advantages. Let's look at the financial levers. 4 is literally the magic number in real estate financing. When you cap your investment at exactly 4 units, the property still qualifies for residential financing. If you step up to 5 units, boom, you are pushed straight into commercial financing. That brings entirely different underwriting rules, much stricter terms, and frankly higher costs. Getting those residential loans is hands down the single biggest reason investors target small multifamily.
And this unlocks a whole package of advantages. First up is income diversification. Look, if a single-family tenant moves out, your income instantly drops to zero. But in a fourplex, a single vacancy still leaves you with 3 other rents to help cover the mortgage. Combine that with the sheer efficiency of maintaining just one location, the massive benefit of that residential financing we just talked about, and significantly lower down payments, and you've got a seriously powerful combination to grow your portfolio.
Which leads us to a really actionable strategy known as house hacking. This is where an owner-occupant lives in one unit of the property and rents out the rest. The incoming rent basically offsets the owner's own housing costs. But the absolute kicker here is that living on site unlocks owner-occupied loan terms. We're talking much better interest rates and remarkably low down payments. It is a brilliant way to get started.
That brings us to Section 3, risks and management realities.
Because concentrated risk absolutely cuts both ways. That efficiency of having just one roof, well, it becomes a huge liability when that roof needs replacing. When a shared system like a main plumbing line fails, you aren't just fixing a problem for one tenant. You are suddenly managing a major repair that hits multiple households all at exactly the same time. It's a highly concentrated financial and logistical hit.
Plus, the day-to-day management friction scales right up too. More units literally mean more tenants, higher turnover rates, and absolutely more maintenance calls. The real core challenge here is tenant proximity. Because your residents literally share walls, parking areas, and yards, tenant quality is incredibly important. One single disruptive resident can easily drive all your good tenants away. This is exactly why small multifamily severely punishes poor property management. You absolutely have to have a highly disciplined screen.
Okay, Section 4, location and strategy. Selecting the right Kansas City neighborhood for small multifamily relies on the exact same fundamentals as single-family rentals. You need to target established, cash flow-oriented parts of the metro. Verify steady rental demand so your building doesn't just sit there empty. Ensure purchase prices make sense relative to the expected rent so the math actually works in your favor. And finally, confirm the area naturally attracts a stable tenant base. That stability is your absolute best antidote to turnover friction.
All right, final section, Section 5. Executing your investment plan.
For out-of-state and local investors alike, relying on a trusted local partner is often the single most practical way to handle those intense management demands. Let's look at some objective performance metrics from Alpine Property Management, Kansas City. They've actually been serving Kansas City investors since 2013. By sticking to disciplined screening and highly responsive maintenance, they maintain a solid 96% occupancy rate and a 98% rent collection rate across a portfolio of over 250 owners. Multifamily is undeniably harder to manage, but a proven local partner like Alpine allows you to scale up safely and efficiently. Which leaves us with one final provocative question. Are you ready to scale your portfolio? Understanding these mechanics is only the first step. Executing is the next. For help managing your Kansas City rental property, call Alpine at 816-343-4520 or visit alpinekansascity.com.